Let's talk about just the general reporting of rental operations for real estate. And probably the best way to learn the rules is to take a look at the related tax forms. So here is our 1040 form that we learned that eventually reports all the income and deductions for our taxpayer. So the most common types of income are listed here on page 1 of the 1040 form. And not seeing rental income, it's probably going to be here under other income in line 8 via schedule number 1. So let's take a look at schedule number 1, additional income. That's this part 1, where we saw a couple of chapters ago the use of schedule C to calculate out the profit or loss for a sole proprietorship. But now here in chapter 9, we're talking about rental real estate. And that's going to be reported on Schedule E, in addition to possibly some other types of income. So let's take a look at Schedule E, called Supplemental Income and Loss, where this first page talks about rental real estate and possibly royalty income. Of course, most people know what real estate is and renting it out, the landlord to a tenant. Royalties is just the lending out of maybe some intangible asset like a copyright or a patent, or even mining or drilling rights to some property, where you would get royalty income for letting that person use that property. But let's focus on real estate. So this Schedule E allows you to report here 3 properties, A, B, and C. And if you have more than 3, you would have to use other Schedule Cs or an attachment to your tax return. So you'll fill in here the location of the real property, the address. And here in line 1B, the type of property using the code numbers down here. So this first 2 is for residents. Really, the first 3 is for residents. For number 1, that would be a single family home. Number 2 would be an apartment or condominium. And number 3 would be a short-term rental, which we'll talk about more so probably in the second video for this chapter. If it's not residential, the property is probably rented to a business or commercial property here, like an office building. Or if it's raw land you're renting out, maybe for grazing to a farmer or rancher, that will be 5. So here's that royalty type, 6. A self-rental is where you're renting probably real estate to a business that you own. Maybe the business is owned by you through a partnership or corporation or limited liability company. And you as the individual own the property as a landlord, renting it to this business that you own or partially own. Okay, that's type 7. We'll talk more about this line 2 in the second video, but for now we're going to assume that the rental property is rented out throughout the whole year to the tenant, and the landlord, our taxpayer, is not using it for personal use. Our landlord is not living on this property that's being rented out at any time during the year. So it is being rented out or available for renting out to tenants the whole year. So we have 3 columns here for reporting income and expenses. And the expenses are pretty much listed in alphabetical order like we had seen in the case of the Schedule C a couple of chapters ago. So let's go through these expenses. Well, in the case of rents, most taxpayers use the cash basis method of accounting, meaning that they report income in the year they receive the rent. So if they get prepaid rent from their tenant, they got to report it early. If they don't receive the rent, it's owed to them, and they're using this cash basis, you got to wait until you collect that rent to report it in the year you collect it. And I'm guessing, this is right now at the beginning of the year 2021, a lot of landlords did not collect all of their rent for the past 2020 year, Maybe they'll collect it, hopefully, in the coming year, this 2021, but they're not going to report it as income until they do collect the income. Also, keeping in mind if the landlord collects a security deposit, that is not rent until the landlord knows for sure that they can keep it, either because of uncollected or unpaid rent or for damages. Now, even though it may be kept for damages, you still have to report that security deposit as rental income. And then if there is a loss, you can deduct the loss. Or if there is cost incurred to make repairs, then probably some place down here you can deduct a repair cost when the amount is paid. The repair cost is paid. Going through this expenses, advertising is a common expense by a landlord because they gotta try to advertise a vacancy, right? Of course, there's free places online like Craigslist. You can advertise for free. You may use a management company and you pay them a fee to find tenants for you or to manage the property. That may also come under this commission cost over here. And again, if it's an individual, not a corporation, you pay them more than $600 a year, you may need to check off these boxes up here saying that you issue to them a 1099 form for the amount they have to report as income. Okay, we've seen the same question here for 1099s back on Schedule C. If the landlord taxpayer has to travel for business purposes, for their real property purposes, you can take that transportation or travel costs. Pretty much the same rules we saw back in Chapter 7, like so many cents per mile driven, possibly airfare, possibly per diem if it's relevant. Cleaning and maintenance, possibly you need to get the unit ready for their first occupancy of the tenant, so that's a legitimate cost. Insurance would be for casualty and liability, and if you have to pay attorneys to evict the tenant or accountants to help you do the bookkeeping for your property, that's kind of professional fees listed here. Again, management fees is typically where you hire someone to manage and communicate and maintain the property for you for a percentage of the rent you charge, maybe 10-15%. Mortgage interest, possibly a big expense if you had to borrow money to buy the property. And just like we've seen before last semester, the bank or financial institution will issue out a Form 1098 showing the amount of interest that was paid during the year. And if it's not a financial institution and you're paying interest maybe to the original seller you bought the property from, it may go down here in line 13. Repair cost is sometimes tricky if the amount is very large. If you really are buying an asset that will last a long time, instead of deducting it as a repair cost, you may have to depreciate the cost over its lifetime. And we've talked about depreciation deductions in the last chapter, chapter 8, via Form 4562. Was it 62? Anyway, we talked about Section 179, bonus depreciation and maker's depreciation. You cannot use generally 179, Section 179 depreciation for the building unless it's qualified improvements made to the property after the property is already bought. Typically, let's say, fixing up the interior or changing the roof. This is after from 2018 on. That's qualified depreciable property. Section 179. Bonus depreciation only applies to tangible property. So, for example, if you're talking about a residential property, that would be maybe the appliances, the refrigerator you buy. Same thing, you can use the 179 for that. Remember, 179 is first, bonus is second, and then makers is third. So most times you don't even reach the maker's depreciation because you already deducted the cost under either 179 or bonus. Again, 179 and bonus usually applies to personal tangible property. Qualified business property, like improvements to the property after 2018, from 2018, may qualify for Section 179. Okay, big costs. Okay, I think that's covered back in our previous chapter, chapter 8. And then anything, well, let's go back up here. Supplies would be like cleaning supplies, maybe office supplies. Taxes would be real estate taxes. And here in Hawaii would be the general excise tax, that 4.5% charge on the rent you collected here would be this taxes down here. Utilities, if the landlord, you pay the utilities, like electricity, water, gas, you would deduct it here. If the tenant pays for it, of course, you would not deduct it as the landlord. And if you can't find an expense here classified, you would probably report it here, attaching a list and putting the subtotal here in line 19, taking a total expense deduction here in line 20, and subtracting it from your rental income here in line 3 would give you the gain or the loss from that property. Again, 3 different properties here. And we'll learn about in the second video, there may be limitations in the amount of losses you can deduct, something called at-risk rules and passive loss limitations that we'll see in the second video on this form 8582. And then there's different groupings of expenses here, ultimately combining all 3 properties either as net income or loss, and the amount, and if it's deductible, the deductible loss over here, and then the amount being eventually reported back on schedule number 1. Again, this whole first page is just for real estate, and then the second page is to report if you're a partner in a partnership or a shareholder in a corporation called an S corporation, or a beneficiary of a estate or trust. Income from these entities may be passed through to the taxpayers and reported here on this page 2 of Schedule E. And you would take a subtotal down here and then report it back on that schedule number 1.